All-time highs, new tariffs, artificial intelligence stocks on fire. But who really made money this week? And why did we just buy the global leader in weight loss drugs? Hey folks, Burke here. Last week, markets broke records again, powered by semiconductors and a Federal Reserve that may be signaling a shift. But the real story isn't the headlines. It's what's happening inside the companies you own. And that's what we break down here each week to help you invest like an owner. We'll get to the top 5 winners and losers in the value-aligned portfolio shortly. But first, here's what moved the market. The S&P 500 gained 0.6%, hitting a fresh high. The Nasdaq posted its 10th record close of 2025, closing at 20,896. What drove the rally? 3 things. Number 1, 88% of companies that have reported early in the second quarter earnings season beat analyst earnings estimates. That is a high percentage. Number 2, a Federal Reserve that might be softening its stance on interest rates. And number 3, investors appear to be looking past the new 30% tariffs set to take effect on the European Union and Mexico on August 1st. Semiconductor companies led the way again, particularly those tied to artificial intelligence, AI. The market's message is clear. AI infrastructure is being built and built fast. Fed Governor Christopher Waller made the case for an interest rate cut. His case for cutting now argued that with the federal funds rate at 4.5 to 450%, monetary policy remains 125 to 150 basis points above the neutral interest rate. That's a sign that at its meeting on July 30th, the Fed at least may soften its rhetoric on interest rates. Economic indicators presented a mixed picture. June retail sales rose 0.6% month over month versus the 0.2% expected, demonstrating consumers getting ahead of tariffs. Meanwhile, initial jobless claims declined to 221,000, marking the 5th consecutive weekly decrease. The producer price index data showed contained wholesale inflation with a 0.0% monthly growth rate, providing Fed officials with flexibility for accommodation. Major financial institutions kicked off earnings season with impressive performances that exceeded analyst expectations. JP Morgan Chase, JPM, up 1.9% for the week and up 23.5% year to date, delivered earnings per share of $5.24, exceeding estimates of $4.48 on revenue of $45.68 billion. The results were driven by better than expected bond trading and 7% year-over-year growth in investment banking fees to $2.5 billion. Citigroup, letter C, up 8.2% last week and up 34.8% year to date, delivered an even stronger beat with significant outperformance across trading and deal fees, resulting in 13% year-over-year growth in investment banking revenues. Citigroup announced at least $4 billion in stock buybacks for the third quarter, reflecting management confidence in capital generation capabilities. Wells Fargo, WFC, down 1.9% last week, but up 16% year to date, also topped profit expectations, despite surprising markets by trimming its net interest income guidance, raising concerns about margin pressures in the evolving rate environment. These results underscore the banking sector's ability to capitalize on market volatility and capital markets activity. Goldman Sachs, GS, up 0.7% on the week and up 24.9% year to date, achieved record quarterly revenues of $4.3 billion in equity trading, benefiting from a 50% surge in trading. The value-aligned portfolio gained 0.2% for the week, pushing our year-to-date return to 5.0%. This keeps us ahead of schedule for the necessary returns for your long-term financial plans. However, within the portfolio, we observed significant divergences. AI chip makers surged while healthcare and industrial names struggled. Let's break it down. Here are the top 5 weekly performers. Number 1, Advanced Micro Devices, AMD, $157, up 7.2% for the week and up 30% year to date. AMD designs central processing units, CPUs, and graphics processing units, GPUs, that power everything from data centers to gaming consoles. This week, it led the entire portfolio. Multiple analysts raised their price targets, Wells Fargo to 185, Citi to 165, on strong expectations for AI server chips and eased export rules to China. AMD remains a top beneficiary of the AI build-out. Number 2 is Tesla, TSLA, $330, up 5.1% on the week, down 18.4% year to date. Tesla is well known as an American multinational automotive company that primarily designs, manufactures, and sells battery electric vehicles, EVs. Tesla is less known for its energy-saving products, including stationary battery storage systems, solar panels, and solar shingles. Since its founding in 2003, and under the leadership of CEO Elon Musk, Tesla has become one of the world's most valuable companies and leads the global battery electric vehicle market with a 17.6% market share in 2024. Tesla's product lineup includes the Model 3, Model Y, Model S, Model X, Cybertruck, Tesla Semi, and Roadster, all of which integrate advanced software and receive over-the-air updates, just like your iPhone. Many do not realize that the company also builds and installs residential and commercial energy products, manages one of the world's largest fast-charging networks, and offers direct-to-consumer vehicle sales, bypassing the traditional dealership model. In recent years, Tesla has pioneered developments in autonomous mobility, rolling out paid robo-taxi services in select markets using its full self-driving FSD technology, and plans to expand these services as regulations permit. Tesla is also advancing robotics with Optimus, a general-purpose humanoid robot designed for various repetitive or hazardous tasks, reflecting its ambition to lead in both autonomy and intelligent robotics. Tesla has a market capitalization of $1 trillion. That seems high if you are only valuing the car company. But Tesla is more, so much more. Marc Andreessen, the prominent venture capitalist and co-founder of Andreessen Horowitz, has made a series of high-profile statements predicting that robotics will become the most significant industry in the history of the planet. He has emphasized that the world is on the cusp of an industrial revolution driven by AI and robotics, suggesting that there could eventually be billions, tens of billions, hundreds of billions of robots performing a vast array of tasks in society. The third best performing VAP stock was Nvidia, NVDA 172 to 41 plus 4.5% WTD, plumb 28.4% YTD. The dominant AI chipmaker announced a massive sale of 18,000 GB300 Blackwell chips to Saudi Arabia's Humane. On top of that, they received a green light from the US to export H20 chips to China. Demand for Nvidia's infrastructure remains relentless. Number 4 was Taiwan Semiconductor, TSMC 240, plus 4.3% for the week, plus 121.7% year-to-date. TSM is the world's largest contract chip maker. They posted a 60% year-over-year profit surge and guided for 30% revenue growth in 2025. Their 3nm and 5mm fabs are running at full capacity, serving customers such as Apple and Nvidia. Number 5 is Ulta Beauty. ULTA 493, 3.5% week-to-date, 13.4% year-to-date. Ulta is a specialty beauty retailer. It performed quietly as consumer spending held up and demand for beauty products remained strong. It's not flashy, but it's profitable and resilient. And now the worst weekly performers. Funny enough, the worst weekly performer was ASML Holding, ASML $734, down 8.4% last week, but up 6.0% year-to-date. ASML is a Dutch technology company and the world's leading supplier of photolithography equipment used in semiconductor manufacturing. It is the exclusive provider of extreme ultraviolet EUV lithography machines, which are essential for producing the most advanced computer chips used in AI, smartphones, and data centers. ASML also offers deep ultraviolet DUV systems, metrology tools, and software solutions that help chip makers like TSMC, Intel, and Samsung produce faster, smaller, and more efficient semiconductors. It beat Q2 expectations, but offered a cautious outlook for 2026. ASML management stated they cannot confirm growth in 2026, moving away from earlier optimism. The company cited rising macroeconomic and geopolitical uncertainty, which is impacting customer spending and capital investment decisions, including prolonged US-China tariff issues and the return of Trump-era tariffs. 2. Installed building products. IBP 108.2% WTD, plus 5.0% YTD. IBP installs insulation and other building materials in residential construction. Shares fell on concerns about a 6% drop in install volumes and broader housing softness, despite some analysts raising price targets. 3. Novartis, NVS, 114.25, 5.6% WTD, plus 18.8% AD. Novartis is a Swiss pharmaceutical company with a deep pipeline in oncology and biosimilars. It declined this week due to sector-wide rotation out of healthcare. No company-specific news, just macro pressure. 4. Permian Resources, PR 13045, 5.0% WTD, 6.5% YTD. Permian is a pure-play oil and gas driller in the Delaware Basin. Crude oil prices dropped more than 8% this month, and that dragged PR down too. Supply-demand sentiment remains shaky. 5. Thermo Fisher Scientific, TMO 414.75, down 3.4% WTD, down 20.1% YTD. TMO is a global leader in providing scientific instruments, reagents, consumables, and integrated services for research, healthcare, and industrial applications. The company is structured across 4 key segments: life sciences solutions, analytical instruments, specialty diagnostics, and laboratory products and biopharma services, serving over 250,000 customers globally. We have owned TMO for nearly 20 years. It has returned 14.3% per year during those 20 years. Thermo Fisher's value proposition lies in its one-stop shop approach, delivering comprehensive solutions that accelerate research, optimize productivity, and streamline laboratory and manufacturing operations for scientific and healthcare clients. Its vast scale, commitment to R&D, and ongoing strategic acquisitions further empower customers to innovate and achieve breakthroughs efficiently. Last week, we made several targeted adjustments to the portfolio. We trimmed winners like Nvidia and Broadcom to lock in gains and maintain position discipline. We added to existing high-conviction names, including AMD and Thermo Fisher, leaning into strength and selectively buying weakness. We also exited small positions in Fiserv and advanced drainage systems, not because of performance, but because they were too small to move the needle. Focus and clarity matter more than ever. But the most crucial move we made, we bought Novo Nordisk NVO 6431, down 6.2% for the week and down 24.3% year to date. Novo Nordisk is the world leader in GLP-1 medications for diabetes and weight loss. With brands like Ozempic, Wegovy, and Rybelsus, they control over 60% of the global GLP-1 volume and dominate the obesity treatment market. So why buy it now? Because the stock dropped nearly 40% from its highs, despite zero change to its long-term thesis. The sell-off followed a modest disappointment in a recent obesity drug trial, CagriSema, as well as concerns about new competition. But here's the truth. Novo Nordisk, scale, patents, manufacturing muscle, and decades of scientific expertise that won't be easily matched. Meanwhile, the addressable market, over 1 billion people globally, is just getting started. At current levels, the stock trades at a 25% discount to its historical valuation. We expect 12% annual earnings growth, a 2% dividend yield, and modest multiple expansion over time. That gets us to 13 to 15% expected annual returns, with less risk than most of the AI-driven growth names. Novo isn't hype. It's a real business solving a real problem, and it just got cheaper. If wealth is your goal, own great businesses and own them with conviction. Subscribe for weekly updates that tell you what's real, not just what's loud. Drop a comment with questions or send us a note if you're ready to align your portfolio with your values and goals. This isn't just a recap, this is your roadmap.